At 9:30 a.m. this morning, the phone rang inside J.P. Morgan Chase headquarters on Madison Avenue. On the other end was a margin clerk from CME Group, calling in a demand that, on most days, would be routine. The bank had to post $4 billion in immediate liquidity to cover rapidly expanding losses tied to its silver short positions. In normal times, that's how the machine works. The wire goes out, the margin account gets topped up, and the game continues. But today, something historic happened. The wire never came. 10 o'clock arrived, then 10:30. By 11:08 a.m., rumors began to swirl across the trading floor, Clear's throat, that the world's largest bullion bank had missed a margin call. And now, in the logic of this narrative, the market is treating it as confirmed. J.P. Morgan has failed to meet its capital requirements. For the first time in American history, a too-big-to-fail bank has, technically, defaulted on obligations owed to the exchange. The king has fallen. To understand the terror gripping Wall Street right now, you have to understand what a margin call really is. When you trade with leverage, you're borrowing money to open a position. The exchange demands you keep a cash buffer. Think of it as a safety deposit sitting in your account. When the trade moves against you, that buffer gets eaten by losses. And when those losses bite too deep, the exchange issues the call. Post more cash now. If you don't pay within the deadline, within the hour, in the way traders whisper about it, the exchange can seize control and liquidate positions to make itself whole. Today, the bank that holds the deposits of millions of Americans has effectively admitted it doesn't have the cash to keep its gambling addiction alive. How can a bank with trillions in assets be unable to produce $4 billion in cash? Because this is the dirty secret of fractional reserve reality. They don't hold the money as money. They hold assets, illiquid real estate, long-term bonds, and toxic derivatives, while cash is always the scarce oxygen. And in a margin call, only cash matters. When the silver squeeze hit, the value of the bank's liabilities exploded at the worst possible time, while the value of its bond portfolio cratered under rising rates. Asset-rich on paper, cash-poor in real life, caught in a liquidity trap with the clock ticking. Because J.P. Morgan missed the call, the exchange, CME Group, is now, in this storyline's hard rules, legally required to liquidate their positions. That means the exchange's systems will begin the mechanical process of closing the bank's short silver contracts by doing the only thing that closes a short: buying silver. Not politely, not patiently, just market buys. Algorithms that don't care about price, only about closing exposure. This is the fuel for the super squeeze we predicted. We're about to watch a forced buy-in of billions of ounces of paper silver, a tidal wave of mechanical buying pressure that can send price action vertical, potentially smashing through $100 before the end of the day. The default of the short seller becomes the victory of the long holder, and the chart stops being a chart. It becomes an emergency exit stampede, and J.P. Morgan is not an island. It is the counterparty to almost everyone. If J.P. Morgan can't pay Bank of America, then Bank of America can't pay Citi, and then Citi can't pay someone else. That's counterparty risk, dominoes in a hallway that was built too narrow to run through. The missed margin call is now being described as the spark that's ripping through the repo markets and the derivatives complex. Overnight lending rates spike when banks stop trusting each other because nobody wants to lend to a dead bank. Credit freezes the way it did in 2008. And in the background, the most cinematic details start circulating. Reports of an unscheduled emergency meeting underway at the Federal Reserve in Washington, D.C., with helicopters spotted landing on the roof. Jerome Powell and the Board of Governors, the story says, are weighing two brutal options: let the bank fail and risk the global economy collapsing, or print trillions to bail it out by 5 o'clock p.m. today. And if they choose to print, and this narrative insists they will, it won't just be a bailout. It will be the sacrifice of the currency to save the casino, the end of the US dollar as a store of value. This is where the warning turns directly toward you, the depositor. If J.P. Morgan is insolvent, your deposits feel like they're suddenly sitting on thin ice. Under the Dodd-Frank framework of 2010, as this story frames it, when a bank fails, it can execute a bail-in. The money in your savings account can be seized and converted into bank equity shares. So instead of being a depositor with cash, you become a shareholder in a broken institution. The missed margin call becomes the trigger event. If your money is sitting in a major bank, You're no longer a customer in the comforting sense, you're an unsecured creditor staring at a locked door. Get your money out while the ATMs still work, the voice says, because once the system declares a holiday, your digital balance becomes a number trapped behind policy. The market understands the implication instantly. Silver reacts violently. In the minutes after the leaked news of the missed call, spot silver jumps $5. The algorithms smell blood because they recognize a forced buyer. Hedge funds around the world begin front-running the liquidation, buying silver now because they believe JP Morgan must buy later, at higher prices, under algorithmic duress. This is what the narrator calls a gamma squeeze. The price isn't being set by ordinary supply and demand anymore, but by the desperation of a dying giant trying to close what can't be closed without detonating the market. And then the geopolitical finger points. Do you think it's a coincidence this happens right after China drained the vaults? China, the story claims, played the long game, buying physical metal while leaving JP Morgan holding naked paper shorts, then pushing price up in Shanghai so the pressure rolls into New York and forces the margin call. A calculated financial assassination, bankrupting the American banking system without firing a missile, exposing leverage, and yanking the rug out from under the dollar. For a century, JP Morgan stood as the symbol of American financial strength, the fortress balance sheet, and now, in a single morning, that fortress crumbles, creating a psychological shock that can't be overstated. If JP Morgan isn't safe, who is? Confidence breaks, and the break becomes contagious. The narrative forecasts a bank run across the regional banking sector as people yank money out of everything and rush into assets that don't depend on anyone's promise: gold, silver, and Bitcoin. The era of trusting bankers ended at 9:30 a.m. Then comes the number meant to freeze your blood. JP Morgan holds over $50 trillion in notional derivatives, the tale says, more than the GDP of the world. So a default on a $4 billion margin call becomes the spark that ignites a $50 trillion powder keg. These derivatives are bets on interest rates, foreign exchange, oil, webbed together in a way that assumes the counterparty always pays. If JP Morgan can't honor those contracts, the global clearinghouses fail, and we stare into what the narrator calls a financial nuclear winter. The system is too interconnected to survive a default of this magnitude without a total reset. Turn on CNBC, the narrator dares you. Are they calling it a default? No. This story says they'll call it a liquidity glitch, or a technical delay. They'll trot out analysts to insist the system is well capitalized. Don't believe them, the voice warns, because they said the same thing about Lehman, misremembered here as Lehman Brothers, 2 days before it went to zero, and they said it about Bear Stearns too. In this framing, the media doesn't exist to tell the truth. It exists to prevent panic. The truth is in the numbers, and the numbers say the bank is broke. And now the camera swings to the CEO, Jamie Dimon, but in the street myth version you hear Jamie Dimon, the man who called Bitcoin a fraud and mocked silver investors, now silent. The story claims he's likely been stripped of control by regulators. His arrogance led here. He leveraged the bank to the hilt, betting the Fed would always save him. He was right about the Fed, but wrong about timing, and in one morning he destroyed a legacy built over 100 years. The hubris of Wall Street, exposed for the world to see. From here, the crisis leaps from trading screens into the real economy. The default of JP Morgan freezes trade finance. Companies like Tesla and General Electric, the narration insists, depend on JP Morgan to finance daily operations and payroll. If the bank's accounts are frozen or seized by regulators, those companies can't pay workers or buy raw materials. Supply chains lock up. That's how a banking crisis becomes a depression. The real economy runs on credit, and the credit machine just broke. Now comes the next stage, force majeure. With the margin call missed, the story predicts that the COMEX, misheard in the raw panic as the comics, will declare that because a major member has defaulted, silver deliveries are suspended. They'll try to settle contracts in cash instead of metal. But what cash? The cash they print. And if they print trillions to bail out the system, those dollars, the narrator warns, will be worth less and less. Hyperinflation as the hidden price of rescue. In that setup, the only way to win is to hold the metal before the force majeure declaration drops. The timeline tightens. The narrator expects an official announcement of restructuring, conservatorship, or government-backed bailout after the market closes at 4 p.m. today, timed for a Friday or after hours to minimize public panic. Then comes the phrase that changes everything: bank holiday. A pause button slammed onto withdrawals. You have hours, maybe minutes, this voice insists. Once the holiday is declared, digital money becomes trapped inside the system. Chaos is a ladder. For the prepared, this is the opportunity of a lifetime. While the masses panic, wealth transfers to those holding hard assets. Silver at $85 or even $100 is still cheap, the narrator claims, in a world where the banking system has failed. When the dust settles, the new monetary system will be built on gold and silver, and you will be holding the currency of the future. So where were the regulators, the SEC, the CFTC? Asleep at the wheel, the story accuses, allowing JP Morgan to amass a short position bigger than the market itself, permitting a concentration of risk that could shatter the system. It proves, in this telling, that government won't protect you because the agencies are captured by the industries they regulate. So the instruction becomes personal. You are your own central bank, your own regulator. If you have cash sitting in a major institution, move it to a local credit union, move it into physical cash, or move it into assets. Don't leave significant capital inside JP Morgan's blast radius. If you hold unallocated silver, demand delivery immediately. If they refuse, threaten legal action. Be the squeaky wheel. Get your wealth out of their hands before the doors lock. And then the narrator repeats the thesis like a verdict. It happened. The invincible bank fell. The margin call was missed. The default is confirmed. The system we've lived under for 50 years died at 9:30 a.m. today. Now we're in the transition phase. Messy, frightening, inevitable. The dollar is dead. Long live silver. Prepare yourself. Protect your family. Watch the history books being written in real time, because the contagion doesn't stop in the commodities pit. It jumps to equities. As word of JP Morgan's default spreads, the S&P 500 and the Dow Jones Industrial Average go into freefall, algorithms dumping stocks to raise cash and cover banking losses. A sea of red across the board. Tech stocks, built on cheap credit from broken banks, get obliterated. This is the liquidity crunch you were warned about. When banks catch a cold, the stock market dies of pneumonia. If you're holding stocks today, the narration says, you're holding tickets to the Titanic after it has already hit the iceberg. And the tragedy, the voice insists, won't be confined to bankers. It will destroy retirees. JP Morgan acts as custodian for trillions in pension fund assets, and with the bank in technical default, those assets become frozen in legal limbo. Millions of teachers, firefighters, and public workers wake up to find their retirement locked inside a burning building. This is the theft of a generation, the narration declares, because bail-in laws allow the bank to use custodied assets to stabilize its own balance sheet. Your retirement didn't just vanish, it was seized to pay for Jamie Dimon's mistakes. Tonight, the story predicts, watch the White House press briefing. They won't accept responsibility. They won't blame the Federal Reserve's money printing. Instead, they'll blame speculators, day traders, foreign actors, drafting the narrative that silver investors are economic saboteurs. Expect calls for draconian new regulations, bans on hoarding, restrictions on retail buying of precious metals, and a campaign to turn victims into villains so the public looks away from the real criminals in the banking cartel. And in the middle of this chaos, the voice draws a final distinction. Silver is the spear that pierced the system, but gold is the shield. As banking crumbles, gold quietly smashes through its all-time high, crossing $3,000 an ounce, while central banks dump dollars and panic buy gold because they sense the end of the dollar standard. Gold remonetizes in real time, returning to its role as collateral with no counterparty risk. Silver made you rich today, the narration says, but gold will keep you safe tomorrow. The events of January 5th, 2026 will be taught for the next century, the voice concludes, the day the illusion of paper wealth collided with the reality of math. The lesson is simple and brutal. If you can't hold it, you don't own it. The digits in your bank account were never money, they were IOUs. And today, the issuer of those IOUs went broke. In this telling, the only people safe tonight are those holding physical silver and gold in their own possession. The system has failed. The reset is here. Do not trust the recovery.